Welcome, my name is Arvid Streimann and I'm pleased to have Alan, Emma and Ryan here with me today. And what we're going to discuss is the outlook for companies, the outlook for markets and how the fund's positioned. And it's been a really interesting 12 months. The markets are up 25% or so, and there's been a few big things going on. We've had AI, and of course everyone's heard about AI, and the companies which have been leveraged to AI I think have done quite well. And that's in contrast to some of the more defensive names, and I think they haven't done quite as well. They've underperformed the index, not quite fallen, but I think that they've underperformed the index and maybe been left behind a little bit. I'm pleased that our funds have performed well in the past 12 months and in accordance with their investment goals. The Global Fund has broadly kept pace with markets, and that's despite its inbuilt defensiveness, and that defensiveness will be most valuable when markets inevitably decline and go through a rough patch. And the High Conviction Fund has outperformed the broader market, and it's outperformed its through the cycle goal. In fact, it's more than doubled its through the cycle goal over the past year. What I also think is really encouraging is that we haven't taken big bets. We've done what we've always done, which is invest where we have conviction in the quality and where we have conviction in company valuations. And it's also helped that the funds have been fully invested, and they still are. And we can get on to the outlook in a moment. But first I want to turn to you, Alan. What are your observations over the past 12 months?
Well, thanks, Arv. Thanks for having me here. It's been a fascinating year for markets this year, as you know. A very strong year for markets, 20% plus returns. Of course, we started out the year thinking a lot about the Magnificent Seven. You remember 2022, the outsized returns that those seven stocks delivered over that year. And I was arguing quite strongly earlier in the year, and I think you agreed with me, that most of this return was actually being driven by fundamentals. They had come off a very poor year previously. They were cheap in absolute terms. Our valuations were showing 20 to 30% returns on some of our highest quality companies. And that was an opportunity to lean into some of those companies there. And we did see a big change in market sentiment, of course, as AI came through, and that started to drive some of these Magnificent Seven companies. Now, I think it's been really interesting the last 6 months. We've actually seen a bit of a shift in the market. Some of those companies have fallen away. Things like Tesla have obviously fallen a little bit out of favor from the market. And it's really been coming around these semiconductor plays, the chip manufacturers and the whole infrastructure around chips have been driving the markets more at a holistic level over the past 6 months or so. And so while we were discussing about the fundamentals and how they were driving returns and how that looked fine. Valuations were actually okay in that environment because they were being driven by profit growth, strong revenue growth, really strong cash flow, strong buybacks, and an outlook which is really positive, underpinned by things like the shift to the cloud. The AI contribution was giving us increased confidence around that going forward. So that was really interesting. The last 6 months, as I said, shifting more to a narrower focus, I think. And I think there's starting to be some speculative elements starting to creep into the story there in some of those stocks. But overall, it's been a fascinating year. What is interesting, and I know we're going to talk about the outlook later on, is it has left some more defensive stocks behind, as you said, and been really focused on those AI stocks and those AI plays. But that's likely to become I guess, more interesting going forward, given valuations in those AI plays are now fairly elevated relative to where they were a couple of years ago. And I think that's really interesting when we think about psychology, investor psychology. We've actually come full circle over the past 2 years. We had these stocks really underperforming. People were worried about rates, they were worried about recession, the enormous valuations we got, and that negative sentiment has really reversed over the past couple of years, driven those outside gains. And it'll be really interesting going forward where we are now. Sentiment is clearly at a more elevated level. What's going to happen going forward?
Okay, thank you, Alan. I might turn to Ryan right now as the head of our technology and financials team. What do you think has been the most surprising or interesting thing of the past year?
Absolutely. So building on what Alan talked about, I think one of the most interesting things over the past 12 months from my area of coverage has been that improved confidence and restored outlook in some of those tech juggernauts. And so if we zone in on Amazon a little bit, this is a business whose market cap in the last 3 years went from $2 trillion down to $1 trillion and then bounced back to $2 trillion. So very big numbers, both in percentage and absolute dollar terms. I think if we all step back, we'd probably reach the view that a business like Amazon, its valuation doesn't really swing around that much in that period of time. So what happened? Amazon has two main businesses. It has its retail and logistics business, I'll call it Amazon.com, and also the AWS cloud computing business. And in 2022 in particular, the near-term outlook, earnings outlook for those businesses deteriorated meaningfully. So in the case of AWS, what we saw was some optimization by its customers after a period of exuberance during COVID, and also Amazon or AWS taking a measured approach to adjusting its cost base, which we actually think is definitely the right thing to do for that business, given the long-term opportunity in front of it. For the retail business, we saw some reopening headwinds to e-commerce growth and penetration of e-commerce. And we also saw some investments it was making in its business have a near-term impact on that profitability. And what I'm talking about there were increased investment in fulfillment and delivery to expand its one-day and same-day delivery. While that did have an impact on near-term profitability, I would argue these were very moat-enhancing and value-enhancing investments if people were willing to take a longer-term perspective. Now, hindsight's always 20/20, and whenever we do go through these scenarios where we have a bit of a dip in the outlook for a company, there is uncertainty as to what that recovery profile looks like. I think in this case, the drivers of that near-term deterioration were quite clear. I think we had confidence in the decisions the management team were making, the investments they were making. And so in our view, the probabilities of a recovery in that outlook were quite high. And so that was an opportunity for the funds to lean into that volatility, lean into that negative sentiment, meaningfully increase the position size, and do so at very attractive share prices. And you know, it's only been a little while since then, but so far that has proven to be true. I would say that there's actually very similar stories that played out across companies like Alphabet and Netflix. And to Alan's point, you know, while there is this talk about tech companies having driven returns over the past 6 or 12 months, a lot of that was driven by the fundamentals and that these businesses were very cheap.
Well, thanks, Ryan. And I think it's really important that, and I'm glad that you brought up how we lean in and out of companies when the valuations are attractive. That's an important part of the process. And now I'm going to turn to you, Emma, as the person that's leading our consumer and healthcare research efforts. Now, Chipotle is up over 50%, or it's returned over 50% over the past year. And that's an environment where the defensives, which is where a lot of the companies you look at, they haven't performed that well. They've underperformed the market. They've been positive returns on average, but have underperformed the market. And so that's a very interesting thing that's happened. And we've been following the restaurant space for a long time. And so I'd be really interested in how you saw the past year.
Sure, thanks, Arvid. As you mentioned, last year was a really interesting year in the restaurant space, and there was only really a handful of companies like Chipotle that came out as winners against a pretty challenging backdrop for the restaurant companies. And there are a couple of key factors that I'd call out there that have driven that outperformance. I think the first thing to raise was, given the significant levels of inflation that consumers have been suffering over the past couple of years, a key differentiator of how a restaurant brand performed over the past year was really the value for money perception they held in the mind of consumers. A strong value proposition is something we've always liked about Chipotle, so you get a pretty significant volume of food for the price point. But what's been really interesting over the past year is how that relative value proposition has improved. Chipotle's management team took more conservative pricing actions than a lot of its peers, including in the fast food channel, which resulted in, that kind of price gap between what you pay for a Chipotle burrito bowl and the alternative meal you could get in, say, fast food, trading at kind of historical lows. And to give you a sense of then how that's played out in financial results for restaurant companies, I think a really interesting case study is the first quarter of this calendar year over in the US. So over in the US, in the fast food channel, we saw the major fast food brands report negative traffic. So their lower income consumers have hit a ceiling on what they're willing to pay for that food in that channel. A company like Starbucks, which offers a more premium priced beverage product that doesn't have a really strong value for money perception, they reported customer traffic down 7%, which is a pretty material result. In that exact same period, Chipotle reported customer traffic up a really healthy 5%. and importantly, without having to lean into any discounting or promotional activity. And so I think that's the first point I'd highlight, just really showing how that value for money perception has played for them this year. The second factor I'd really attribute performance to has been management execution, not just on product and pricing, but also on their efforts to improve labour retention and restaurant operations, which in turn has resulted in another year where Chipotle's average restaurant sales and restaurant margins have exceeded our expectations and driven earnings upgrades. And the final factor I think I'd call out would be Chipotle's store rollout story. And I know this is a theme we've talked about for a long time here at Magellan, but there's been two aspects of Chipotle's store rollout that I think I would call out as being particularly advantaged in the current environment. Chipotle is rolling out stores through its own company. It's not relying on the financial health of franchisee partners or their access to financing in a higher rate environment. Chipotle's store rollout is also all primarily taking place in a proven home US market. And what that has meant is that that activity has been insulated from some of the macro and geopolitical challenges that we've seen other large restaurant companies face in their store rollout and activity in markets like China or the Middle East this year. So in summary, attribute it to a combination of very strong value, strong management execution, and a high conviction rollout story, which is exactly the kind of structural growth story we like here at Magellan.
I think those are a couple of good examples of stocks that have done well in the high conviction fund. And interesting, one tech company, we know talk a lot about tech, but there are opportunities elsewhere in the market. And Chipotle is a great example that if you focus on the fundamentals and intrinsic valuation, you can find opportunities in many different parts of the market.
So now let's look forward. And I think this is a key investor debate for people who are investing money, because markets are up, let's call it 40% over the past couple of years. And so the market outlook, I think, is vitally important. Now, from my perspective, I suspect that markets are going to rise, but not to the same extent or at the same pace as that they have over the past couple of years. And when we think about markets, or I think about markets, I think that there's always three drivers. And let's go through them. The first one is profit growth. And I suspect with the slowing in the economy, profits also are going to slow down. They're still going to be positive, and so, but just slower. And so what that means is that that particular contributor to stock returns or market returns is going to be, let's call it, modest. The second component or thing that can drive markets is interest rates. And I suspect that interest rates are going to be flat to down over the next little while. And so for market valuations and returns, let's call that a neutral to modest contributor. And the third piece is sentiment. And sentiment's pretty high at the moment, and people are pretty buoyant. I'm not sure they can get much more buoyant, but we'll see. Anyway, I would say that if I had to guess, it's probably going to be fairly neutral. So you've got a couple of modest there and a neutral, and I would say that adds up to, let's call it, a moderate pace of returns or moderate return outlook. The other thing I would say here is that in the past couple of years, or maybe even 4 years or so, I would say that markets have really been driven by macro factors. But when growth starts to slow, those macro factors become less important. And I think that for investors, it's really going to come down to picking individual stocks as opposed to figuring out where the big macro trends are headed, so like interest rates and that sort of thing. So I think that when we're thinking about where those returns are going to come from, look at some of the things that we've been talking about before. We've had a very large divergence in stock returns at the AI side and the defensive side, and it's in these types of environments that you tend to see some of these companies get left behind. And so I think that's a pretty interesting place to look. Now, our expectation, or my expectation, of modest market returns, there are always wildcards around that, okay? And it's interesting because those wildcards, I think, is very difficult for investors to get a high level of conviction on that. So from my perspective, I think that what investors should do is really stick to their knitting. So for us, I think that that is sticking to those companies where you have a high level of conviction in their quality and a high level of conviction in their valuation as well. But I want to turn it over to you, Alan. What do you think about the next little while that's coming up?
Yeah, thanks, Arvid. As I alluded to earlier, I think it's a fascinating point in markets at the moment. I think we've had a market driven by fundamentals, but as you talked about, sentiment being high, I would say that's a speculative element starting to creep into parts of the market. And I do think that raises the concern that if we do get one of those more black swan events or one of those downside episodes occurring, that there's not much in market valuations for something like that occurring. So I think we really need to make sure that we have that defensive element in place at the moment. I'm not saying that's going to happen, but I'm saying if something does happen, then there is not much defense in the market from valuations. The valuations are full. I wouldn't say they're extreme because the fundamentals have been pretty good, but they are definitely full. So we want to be guarding against that potential downside given our focus here at Magellan. And what's interesting, because the markets have been pulled into this kind of AI fever to a degree, that has pulled a lot of, I would say, investors away from some other parts of the market, which are actually starting to look really attractive. Some of those more defensive parts of the market we talked about underperforming over the last year. These are very high quality companies. They're beneficiaries from AI in a subtle way perhaps, but they're just not getting the market, the attention from investors at the moment. And that can create opportunities for those people focused on the fundamentals, focused on intrinsic valuations, and focused on protecting against the downside. So there's some good opportunities out there to take some insurance, I would say, in case we do get a negative outcome hitting the markets.
Yeah, I think that's really interesting. And I think a lot of where that divergence in returns, the companies that have been on the wrong side of that, or maybe have seen their valuations go on the lower side relative to history, have really been in that defensive space. And this is a space where a lot of the companies you look at, Emma, are sitting in. So what do you think is interesting in the next little while, and what are you focused on?
Sure. So maybe following on from some of those comments, I could give two examples of two companies that I think are looking really interesting after the kind of sector rotation moves of the last year. In consumer staples, a company that comes to mind is Nestle. This is a really high quality consumer staples company that has historically traded at a premium to peers. And that premium has reflected a few things: a really diversified and reliable product portfolio, attractive end category exposures to categories like pet care and coffee and vitamins and supplements, and also a really strong track record of product innovation. However, its more recent results have been unusually disappointing for Nestle, and that has reflected a combination of some industry-wide volume challenges in packaged food, but also compounded by some company-specific challenges in certain categories and a supply chain integration issue. This is a company we've covered for a very long time. We don't think these issues are structural, and we have a high level of confidence that Nestle is going to return to being that defensive core holding that you can rely on, and we expect that valuation gap that's open to peers to close over time.
I think that's something we do pretty well here, looking through those short-term cyclical elements to focus on the structural story of companies. So this could be a good example of that.
Yeah, and the second example I was going to give is actually quite similar. So in the healthcare defensives, one of the companies that our healthcare analyst Wilson's been spending a lot of time on and recently spoke about in the recent Magellan Minutes video series is the US managed care player United Healthcare. I think about this as another company that's been impacted by both sector rotation away from defensive, but also some idiosyncratic issues which we do believe are going to be either short-term or transitory. For example, a recent cybersecurity incident. So that has opened up a really attractive valuation opportunity for a company that not only offers defensive characteristics, but it is also well positioned for the longer term structural shift that we're expecting to take place in the US healthcare system towards value-based care.
And are there any other things that you're looking at the moment?
So one area of the defensive sleeve of the portfolio where we have positioned a little more cautiously into the year ahead is our total exposure to the quick service restaurant companies. These are really high quality businesses. They've been strong defensive holdings for Magellan funds over many years. But just taking stock of where we are today, given some of those value perception issues I mentioned earlier, after a couple of years of really strong price increases in the fast food channel, as well as some challenges these businesses are facing in their international businesses from geopolitical headwinds and a sluggish recovery in China, their earning streams are just proving a little bit less predictable and reliable that we want to see from our defensive holdings. These companies also sit at the pointier end of food categories that could be impacted by consumer behaviour changes from the rising penetration of GLP-1 obesity drugs. This is a structural theme that the team has spent a lot of time on this year. And even though, we do believe that earnings headwinds will be manageable over time, there is a lot of innovation and investment going into this space. So it's a thematic that we're managing our exposure to at a total portfolio level.
Yeah, the GLP-1 phenomenon is really interesting. There's clearly something's happened to the world's calorie consumption trajectory. I don't think that it's going to be a cliff effect. I don't think it's going to change materially in a very short amount of time. But there's clearly been some disruptive event there, and it's interesting. I think we do need, as investors, we do need to react to these new developments. And maybe I'll turn it over to you, Ryan. What are you thinking about in the year ahead?
Yeah, so at the sector level, consistent with some of the things Alan talked about, turning a bit more cautious. And as that sentiment has improved, we're trying to understand where might expectations now be getting ahead of themselves? Where might those strong share prices over the past 2 years mean that the margin of safety, should something not turn out as expected, which is more often than not the case when it comes to investing, provide a margin of safety. So consistent with what Alan talked about, as that market sentiment has improved, we are getting a bit more cautious. We're trying to understand where might expectations be getting a bit ahead of themselves, and where might those strong share prices mean that the margin of safety, should something go wrong, be de minimis. One of the portfolio companies that we remain very excited about is SAP. SAP is the world's leading ERP software company. And the investment thesis for SAP hinges on its transitioning of its very sticky customer base to a more modern version of its software called S/4HANA Cloud. And over the past few years, Adrian, our analyst who covers SAP, has done a huge amount of work talking to the company, talking to key customers like Nestle and Reckitt and others, talking to system integrators to get conviction that customers would stick with SAP, that they would make this transition, and get a sense for what the revenue tailwind would be when they made that transition. Notably, with ERP software, it tends to be very customized. It tends to be embedded in processes and procurement, supply chain that span across the globe. So it's very difficult and costly for customers to upgrade. And so that means there has been this ongoing uncertainty as to exactly when that transition would take place. One of the things we talk a lot about, and you mentioned earlier, was what is our conviction levels in our investments? And from our perspective, I think it was relatively easy to have high conviction that SAP's customer base would make that transition, and it was harder to have conviction on the when. Importantly, SAP was being priced as a mature legacy software provider. So you weren't having to pay for that transition tailwind. We just needed to be patient and wait for it to happen. If we fast forward to today, we're starting to see that occur. We're starting to see momentum in that shift take place. It's already resulted in SAP's revenue growth accelerating towards double-digit levels. And that's seen SAP perform quite well, particularly versus some of its peers, as the market's reappraised its growth outlook going forward. Importantly, because of that difficulty for customers to transition, the cost associated with that migration, we think this is going to be a multi-year journey. We think that transition is going to support healthy revenue growth through the end of the decade and margin expansion along with it. So I think SAP is another great example of the importance for us as investors, and consistent with our process, to really dig into company-specific investment and product cycles, and also the opportunity that markets will provide to patient investors to acquire high-quality businesses at very attractive prices.
Okay, so I think that's been a really great discussion. We've talked a lot about the companies and which ones we're excited about, and where we're seeing markets going. I think is very valuable. So thank you for your time. And thank you for your time to the viewers for listening as well. If you'd like to, please share this with your clients and colleagues. And if you have any questions, please reach out to your distribution contact here at Magellan.